So if you're looking at the screens right now in mid-August 2026, Wall Street is basically pricing in this sort of immaculate conception for the macro economy.
Yeah, it really is. I mean, the S&P 500 is just hovering right near these historic all-time highs.
Right, and we have major desks like JP Morgan confidently raising their year-end targets for the S&P to 8,000.
Which is heavily predicated on the assumption that second quarter tech and cloud earnings actually justify these multiples.
Yeah, and on top of that, headline inflation is supposedly tamed. It's drifting down to roughly 3.4% year over year.
So the narrative has been that the American consumer, the undisputed heavyweight champion of the global economy, is just going to keep swiping their credit cards indefinitely.
Like they're seemingly impervious to interest rates sitting at multi-decade highs. It's been framed as this perfect, impossible economy.
It's a great story on paper.
But our mission for this deep dive is to look past those equity screens and dig into the actual macro data.
Yeah.
Because for you listening, there is a glaring, massive contradiction that just dropped, and it kind of threatens this whole perfect narrative.
Oh, it absolutely fractures that immaculate conception narrative. And that contradiction is coming directly from the July retail sales data.
Right, which caught everyone off guard.
Completely. I mean, we were expecting the baseline resilience to hold, but instead, U.S. retail sales unexpectedly dropped by 0.6% month over month.
Which is a pretty sharp drop, right?
It is the sharpest contraction we have seen in over a year. And the reaction across fixed income and macro desks has been severe.
But why is the reaction so severe?
Because this isn't just a miss on some peripheral data point. We are talking about the core engine of U.S. GDP flashing a structural warning sign.
And doing it at a time when equity valuations are priced for absolute perfection.
Yeah, there's no margin for error here.
I do want to challenge the severity of that reaction, though. Because I look at a 0.6% drop in a single month, and in the context of a $28 trillion economy, that looks like statistical noise.
It sounds small when you just say a fraction of a percent.
Right. I mean, it's a fraction of a percent. We just came through a summer with record TSA checkpoint travel numbers. The service economy still feels incredibly hot.
It does feel hot if you're just looking at travel.
So if people are still packing airports and restaurants, why is Wall Street treating a 0.6% retail blip as if the floor is falling out?
Well, you have to separate services from physical goods.
Yeah.
And more importantly, you have to look at what that 0.6% represents in terms of forward-looking behavioral shifts.
Okay, unpack that for us.
So, consumer spending accounts for roughly 68% of U.S. GDP. It is the absolute bedrock of the economy. Almost 2 out of every $3 generated in the U.S. comes from consumer spending.
Right.
When you see a 0.6% contraction across the board in that specific segment, you are witnessing the initial stress fractures in consumer credit and discretionary income.
So it's the canary in the coal mine.
Yeah, and the reason the market is hypersensitive right now is the context of the calendar. We are in mid-August.
Right, which is historically a volatile time anyway.
Exactly. And we have the Fed meeting minutes looming, oil is creeping up, and the 10-year Treasury yield is stubbornly anchored around 4.7%.
So the margin for error in this economy is essentially zero.
Zero. If that 68% consumer engine is actually losing momentum, the cascading effects through corporate earnings will be brutal, regardless of how many people pass through a TSA checkpoint in July.
Okay, so the thesis is that the consumer is finally buckling under the weight of this prolonged rate cycle. But the headline number is a blunt instrument.
It is. You have to look at the components.
Yeah, when you actually disaggregate that 0.6% drop, where is the bleeding coming from? Because if it's just, a rotation out of buying laptops and into buying plane tickets, that's just post-pandemic normalization.
Right, that wouldn't be a recessionary crisis.
So what is dragging this number down?
When you look under the hood of the July data, the weakness is highly concentrated. And it's concentrated in the most capital-intensive sectors.
The big-ticket items.
Yeah, we saw a massive deceleration in motor vehicle sales, auto parts, and gasoline station receipts.
Oh, wow.
The promotional surge we saw from the auto industry in early summer, the heavy manufacturer incentives and dealer discounts, that has entirely faded.
It basically pulled forward a tiny bit of demand, and now we're staring at an air pocket.
Exactly.
But wait, isn't auto inherently cyclical? We know auto loan rates are sitting near 8% or 9% for prime borrowers.
And much higher for subprime?
Right. So a slowdown in auto sales seems like the intended feature of the Fed's policy, not a bug.
It is working exactly as designed, yes.
I mean, if someone looks at a $900 a month car payment and decides to just fix the transmission on their current sedan and drive it for another 3 years, that's rational economic behavior. It's not necessarily an economic collapse.
Well, it is rational behavior for the individual household. No argument there. But it is deeply problematic for the macroeconomy when millions of households make that rational decision simultaneously.
Because of the ripple effects.
Yeah, this goes far beyond just a missed sale at a local Ford or Toyota dealership. When households become this hyper-selective about discretionary big-ticket purchases, you trigger a massive supply chain whiplash.
Walk us through the mechanics of that whiplash.
Yeah.
Because the disconnect between a consumer skipping a car purchase and, say, a tech stock taking a hit needs to be mapped out for the listener.
Sure. Think about the floor plan financing for these dealerships.
Right, they don't own those cars outright.
No, they finance them. So when cars sit on the lot for 60, 90, or 120 days, the dealers are paying exorbitant interest to finance that inventory.
With rates as high as they are, that's incredibly expensive.
Their margins compress instantly. So in response, they slash their allocation requests from the original equipment manufacturers, the OEMs.
Which means the auto plants have to react.
Right. The auto plants then scale back their production schedules. They reduce orders for cold-rolled steel. They cut back on semiconductor orders. They cancel contracts with Tier 1 and Tier 2 plastic injection molding suppliers.
And those suppliers are massive employers.
Huge employers. So those suppliers subsequently freeze hiring, and they reduce their corporate CapEx budgets.
So they stop buying enterprise software or upgrading their tech infrastructure?
Exactly. Suddenly, a consumer's decision to delay a car purchase translates into reduced industrial production, lower manufacturing payrolls, and slashed forward earnings guidance for a massive swath of the industrial and material sectors.
And that leads directly to the inflation paradox we are currently trapped in. Because the entire justification for these high interest rates was to crush that demand and bring down inflation.
That was the goal.
And on paper, if you look at the July Consumer Price Index, it seems like the Fed succeeded. CPI increased by just 0.1% month over month.
Which is incredibly low.
The annual headline inflation number is sitting at roughly 3.4%. And considering we peaked at 9.1% back in the summer of 2022, mathematically, inflation has been crushed.
On a percentage basis, yes.
But the University of Michigan Consumer Sentiment Survey is flashing warning signs that look more like 2008 than a booming 2026.
The divergence is wild.
If the inflation monster is dead, why is the American consumer acting so defensive? Because for anyone listening, grocery bills certainly don't feel cheaper.
Because we have a fundamental communication breakdown between macroeconomic terminology and household reality.
Okay, break that down.
The media and policymakers celebrate disinflation, which is simply a reduction in the rate of inflation.
Going from 9.1% to 3.4%.
Right, that is disinflation. But the consumer doesn't live in a world of derivatives. They live in a world of absolute prices.
Right, the compounding effect.
The compounding effect is everything here. The 3.4% increase we are seeing today is compounding on top of the 18% to 20% cumulative price increases we've experienced since the pandemic began.
So things are still getting more expensive, just at a slightly slower pace.
Exactly. Inflation measures the velocity of price increases. The velocity is slowed, but the absolute altitude of prices, rent, auto insurance, groceries, healthcare, remains permanently elevated.
And deflation, which would be prices actually returning to 2019 levels, is not happening.
Deflation is not happening at all.
Which means real wage growth is likely negative for a massive cohort of the population when you factor in the necessities.
Yes, because you can't substitute your way out of auto insurance or rent.
You just have to pay it. And that brings us to the behavioral economics driving this 0.6% retail drop. The Michigan survey shows consumers are hypersensitive to these structural costs. It feels like we are hitting a psychological breaking point, not just a financial one.
Consumer psychology is always a leading indicator. The behavioral shift we are seeing is rooted in uncertainty.
Unpack that a bit.
A household doesn't need to be completely out of cash to stop spending. They just need to feel uncertain about their future cash flows or their future fixed costs.
So it's about confidence, not just checking account balances.
Exactly. If you have $10,000 in a savings account, but your property taxes just jumped 20% and your grocery bill is permanently 30% higher, you are going to clench your fists.
You delay the kitchen remodel.
You delay the remodel. You don't buy the new car. You preserve capital because the macro environment feels predatory.
So we have a heavily spooked consumer, hoarding whatever discretionary capital they have left, triggering this 0.6% contraction in retail sales. This fundamentally changes the math for the Federal Reserve, doesn't it?
Oh, it drastically alters their calculus.
Because we went into this summer with the market intensely debating whether the Fed might actually have to hike rates again to break the back of sticky inflation.
Right, the higher for longer narrative.
But this retail data seems to have entirely flipped the script.
It has violently repriced the forward curve. If you look at the swaps market and Fed funds futures, financial markets have rapidly dialed back their expectations for tighter policy.
So what are the odds now?
The probability of a September interest rate hike has collapsed to roughly 30%.
Wow.
Just a few weeks ago, a hike, or at least a violently hawkish hold, seemed like a base case scenario for many desks.
Which brings us back to the glaring contradiction I brought up at the start.
The S&P 500 paradox.
Yeah. We have stalling consumer engine, retail sales contracting, and the market pulling forward expectations of a dovish Fed pivot. Precisely because the physical economy is showing signs of structural weakness.
Right.
And yet, the S&P 500 just closed its third consecutive weekly gain. JP Morgan is pointing to an 8,000 year-end target. We are staring at a textbook divergence.
It looks completely irrational on the surface.
How is the market justifying a historic rally on the back of an economic deterioration?
The justification lies in the mechanics of equity duration and the heavy concentration of the S&P 500 in mega-cap technology and artificial intelligence companies.
Okay, how does equity duration work in this context?
You have to view these specific tech stocks essentially as ultra-long duration bonds.
Because their payoffs are so far out in the future.
Yes. Their valuations are heavily dependent on massive cash flows projected 5, 10, or 15 years into the future.
And the discount rate applied to those future cash flows is intimately tied to Fed policy and interest rates.
Right. So when the market sees weak retail sales, they don't think, oh, Apple or Microsoft is going to sell fewer software licenses today.
They think about the Fed.
They think the consumer is weak, therefore the Fed cannot hike rates and might even be forced to cut.
And when rates go down, valuations go up.
Exactly. When the expectation of future interest rates drops, the discount rate applied to those massive future tech earnings also drops. That mathematically increases the present value of those stocks today.
But isn't that a wildly asymmetrical and fragile bet?
Highly fragile.
Wall Street is effectively betting that the macro slowdown will be just bad enough to force the Fed to back off, but not so bad that it actually destroys corporate earnings.
It's the Goldilocks landing on a razor's edge.
Yeah. But if the consumer continues to pull back, eventually the E in the PE ratio for the broader market has to collapse.
Earnings have to matter eventually.
Right, you can't have a 68% consumption-driven economy contract without it hitting enterprise software spend, advertising budgets, and cloud computing consumption.
It is an incredibly fragile bet, and it relies on the assumption that inflation is permanently subdued, allowing the Fed to ride to the rescue with lower rates if growth stalls.
But that assumption is actively being threatened right now.
Yes, by the bond market and the commodities market. The silent threats are oil and treasury yields, and they are completely ignoring the Goldilocks narrative.
Let's pull the lens back and look at the geopolitical overlay, starting with energy. Because Brent crude is currently stabilized around $87 to $89 a barrel.
Which is high given the demand picture.
Right. This isn't driven by a sudden surge in global demand. The U.S. consumer is weak, and Chinese macro data has been sluggish.
Very sluggish.
This is entirely a supply-side risk premium being priced in due to shipping uncertainties in the Middle East.
The geopolitical fragmentation in the Red Sea and the broader Middle East is effectively acting as a tax on global trade.
Because vessels literally have to take a longer route.
Exactly. When ships have to reroute around the Cape of Good Hope, you aren't just adding days to a journey. You are absorbing massive amounts of global shipping capacity.
Which tightens the market and keeps prices high.
It keeps Brent crude elevated. And $89 oil might not sound like a historic crisis. I mean, we've seen spikes well over $100, but it is more than enough to act as a highly destructive multiplier effect on the domestic U.S. economy.
Trace that multiplier effect for us, because I think people tend to view oil strictly through the lens of the price at the local gas station.
Which obviously impacts discretionary income.
Sure, but the industrial impact is far more insidious when it comes to inflation data.
The primary transmission mechanism is the diesel market.
Okay, how does that work?
When crude sits at $89, the crack spread, which is the cost to refine that crude into middle, descalates like diesel usually widens. And diesel is the lifeblood of the physical economy.
Everything moves on diesel.
Everything. Every piece of food in a grocery store, every package delivered to your door, every raw material moved to a factory travels via a diesel-powered truck or a freight train.
So freight rates naturally have to surge to cover the fuel surcharges.
They surge, and those elevated logistics and distribution expenses hit the balance sheets of wholesalers and manufacturers.
So the cost of doing business goes up across the board.
Yeah, and for a while they might try to absorb those costs to maintain market share, but eventually corporate margins crack. They pass those costs downstream to the retailers.
The retailers, who are already dealing with consumers who are balking at high prices, have no choice but to pass those input costs onto the final shelf price.
Which filters directly back into the headline CPI data, potentially causing inflation to reaccelerate entirely from the supply side.
That is the nightmare scenario for the Federal Reserve.
It really is.
They are staring at a consumer who is actively retrenching, evidenced by that 0.6% drop in retail sales, and simultaneously facing a commodity-driven inflation shock that they have absolutely zero control over.
Jerome Powell cannot print barrels of oil or clear shipping lanes.
Right. And that nightmare scenario is exactly what the bond vigilantes are currently pricing into the U.S. Treasury market.
The bond market rarely lies.
If you want to know the absolute truth about the global economy, you don't look at the S&P 500, you look at the 10-year Treasury yield. And currently, it is anchored at a stubbornly high 4.65% to 4.70%.
Which is fascinating, because if the market truly believed the retail sales drop was going to force the Fed into a dovish pivot, you would expect the 10-year yield to be collapsing.
But it's holding its ground.
It's a violent tug of war. The bond market is attempting to reconcile two opposing forces here.
What are they?
The front end of the yield curve is heavily influenced by the immediate Fed policy expectations, reacting to the weak consumer data.
So the short term thinks rates might drop.
Right. But the long end, the 10-year yield, includes the term premium and long-term inflation expectations. The bond market is looking at $89 oil, it's looking at sticky 3.4% services inflation, and it is demanding a 4.7% yield to compensate for the very real risk that inflation is structurally entrenched.
And the gravity of that 4.7% yield cannot be overstated for anyone listening. It is the fundamental baseline for the cost of capital globally.
It drives everything.
It dictates the 30-year fixed mortgage rate, which is why the U.S. housing market is essentially frozen in carbonite right now.
Trapped by the lock-in effect of legacy 3% mortgages.
Right. Nobody wants to sell and trade a 3% mortgage for a 7% mortgage. And it also sets the benchmark for corporate refinancing,
Which is a massive looming issue.
We have massive tranches of corporate debt coming due over the next 24 months that were originally financed at near zero rates.
Maturity wall.
If they have to roll that paper over with the 10-year at 4.7%, corporate interest expenses are going to explode. Yeah. And that forces widespread layoffs to defend margins.
That is the structural reality that the equity market is currently choosing to ignore. But the sources we are looking at provide some brilliant micro clues.
Let's talk about those.
Yeah, these are specific corporate stories that actually reveal how institutional capital is navigating this macro transition beneath the surface. These aren't just isolated news items, they are symptoms of the structural divergence we've been discussing.
Let's dig into those micro clues, starting with the recent price action in Reddit. We saw the stock surge nearly 15% almost instantaneously.
Just massive volume.
But it wasn't driven by a massive earnings beat or a new monetization strategy or a sudden spike in daily active users.
None of that.
It surged entirely because it was added to the S&P 500 index. This is pure mechanics story, but it says something profound about market structure today.
It highlights the absolute dominance of passive investing and structural capital flows.
How does that work in practice?
When a company is added to the S&P 500, every single passive vehicle, every Vanguard index fund, every BlackRock ETF, every state pension fund that benchmarks to the S&P is mathematically obligated to buy those shares.
There is no active portfolio manager assessing Reddit's free cash flow yield or its macroeconomic vulnerabilities.
No one is checking the valuation. It's indiscriminate forced buying, a highly sophisticated algorithm just executing a mandate regardless of valuation or the 0.6% drop in U.S. retail sales.
And when you have trillions of dollars operating on autopilot, it creates massive momentum distortions.
It helps explain why the S&P 500 can keep levitating even when the fundamental economic data begins to rot.
The passive flows act as a relentless bid under the market, completely divorced from the physical reality of the American consumer.
Exactly.
The second corporate clue centers around the revival of M&A mergers and acquisitions.
We're seeing a lot of movement here.
We are seeing elevated trading activity in massive enterprise software names like PayPal and Workday. And this is heavily driven by reports of private equity interests and strategic buyouts.
Right.
Now, private equity has been sitting on the sidelines for over a year because the debt markets were too volatile and the cost of leverage was too high. What does their sudden reentry tell us?
It signals that the smart money, the institutional megafund sitting on hundreds of billions in dry powder, believes that the credit markets have finally stabilized enough to accurately price risk.
Even with the 10-year yield up at 4.7%?
Even at 4.7%, yes, because the volatility in the bond market has compressed. Private equity firms can finally model out their debt servicing costs with a degree of confidence.
They just needed the turbulence to stop.
Right. They're looking past the current consumer weakness, betting that the Fed has capped the upside on rates, and they are moving to acquire highly cash-generative, essential software businesses.
Which are relatively insulated from a consumer recession.
Exactly. They are buying the infrastructure of the economy, not the consumer-facing discretionary brands.
And the third micro clue is perhaps the most indicative of the era we are entering. The massive rally in U.S. domestic drone manufacturers following the government's announcement of a 100% tariff on imported unmanned aircraft systems.
This is the wild card of industrial policy and protectionism.
Yeah, you could spend all day analyzing CPI prints and consumer credit card data, but a sudden stroke of a pen in Washington can instantly reshape the margin profile of an entire sector.
The 100% tariff forces defense contractors and commercial buyers to completely reshore their supply chains.
It effectively acts as a massive subsidy for domestic producers, insulating them from the broader macroeconomic headwinds.
It really does.
If you synthesize these three stories, the passive index flows driving Reddit, the private equity dry powder targeting enterprise software like Workday, and the protectionist tariffs shielding domestic manufacturing, you get a very clear picture of why the stock market is so resilient.
Because none of those three structural forces require a healthy, thriving middle-class consumer to keep functioning.
Insulated systems.
Entirely insulated.
Which brings us to the ultimate reckoning. We can analyze macroeconomic abstractions and institutional capital flows all day, but eventually, the rubber has to meet the road.
The physical economy has to be accounted for.
The true lie detectors of the U.S. economy are about to report earnings. We are talking about the upcoming quarterly reports from Walmart and Target.
These two companies operate at a scale that effectively makes them proxy indicators for U.S. GDP.
They are the ultimate ground truth. Walmart serves as the definitive barometer for the necessity economy, grocery demand, and value-oriented trade downs.
And Target, on the other hand, is heavily levered to discretionary spending.
Apparel, home goods, consumer electronics.
Together, their data will tell us exactly how much damage that 0.6% retail drop actually represents.
But Wall Street isn't just looking at the top-line revenue numbers, because in an inflationary environment, revenue is a mirage.
It tells you nothing about volume.
Right. If Target raises the price of a t-shirt by 5% and sells the exact same number of t-shirts, their revenue grows, but their actual volume is stagnant.
Yeah, you have to dig deeper.
So what are the specific forensic accounting metrics that institutional analysts are going to tear into on these earnings calls?
The first and most critical metric is comparable store sales, or comps.
Why comps?
This strips out the artificial growth generated by simply opening new store locations. It measures the pure organic health of locations that have been open for at least a year.
Okay, so if comps are negative.
If comps are negative, it means foot traffic is declining or the average ticket size is shrinking.
And composition of that ticket size is just as important, right? They will be heavily scrutinizing the product mix.
The gross margin profile tells the whole story.
How so?
Well, groceries are a notoriously low-margin business. Discretionary items like clothing and electronics are high-margin.
Right.
If Walmart reports that their top-line revenue is holding up, but their gross margins are collapsing, it means the consumer is spending 100% of their wallet just to put food on the table.
Completely cannibalizing the high-margin discretionary purchases.
Exactly. That is the survival economy taking over.
And that leads directly to the third indicator you look at. Inventory to sales ratios. We discussed the auto dealerships facing floor plan financing crises when cars sit on the lot. Retailers face the exact same physical reality in their distribution centers, don't they?
Oh, absolutely. If Target modeled out a mild summer and ordered millions of patio sets, but the consumer balked due to economic uncertainty, those patio sets don't just disappear.
They pile up in warehouses.
They pile up, incurring massive storage costs. And inventory bloat is a massive red flag.
And it forces the retailer to execute aggressive, margin-destroying markdowns just to clear the product.
Analysts will be aggressively questioning the C-suite on their inventory clearance strategies during these calls.
But the metric that will likely move the broader market the most is their forward guidance, particularly regarding the upcoming holiday shopping season.
The Q4 guidance is everything.
Because these executives have access to real-time, high-frequency credit card data, they know exactly how the back-to-school shopping season is trending day by day.
They see the micro shifts in consumer behavior weeks before the Bureau of Labor Statistics compiles their government data.
They know if households are suddenly shifting to private label store brands instead of premium labels.
They know if shoppers are delaying their purchases until the final promotional weekend.
So if Walmart and Target use this earnings call to guide down their Q4 expectations, signaling that they anticipate a highly frugal, highly promotional holiday season,
it will shatter the remaining optimism on Wall Street.
because it would definitively answer the trillion-dollar question. The consumer is tapped out.
And that brings us back to the core tension we have been mapping out today. We are looking at an economy that is broadcasting two entirely irreconcilable realities.
Yeah, on one side of the ledger, you have the financialized economy. Wall Street is euphoric, riding the wave of automated passive index flows, celebrating resilient mega-cap tech earnings, and aggressively pricing in a dovish pivot from the Federal Reserve that will lower the discount rate.
Which theoretically justifies those historic equity multiples.
While on the other side of the ledger, you have the physical, localized economy.
Yeah.
Main Street is suffocating under the cumulative weight of 20% price increases since 2020.
They're facing $89 oil threatening to push inflation higher from the supply side.
They are staring at 4.7% Treasury yields, locking up the housing market. And they are actively retreating, evidenced by the 0.6% contraction in retail sales and the sudden glut of inventory at auto dealerships.
The structural forces driving the S&P 500, the AI capex cycle, private equity M&A, passive Vanguard flows, are entirely divorced from the household cash flows of the median American family.
Which leaves me with a final, somewhat disturbing thought for you to consider as we wrap up this deep dive.
What's that?
If the financial markets have truly decoupled from the physical economy, if equity valuations are increasingly dictated by algorithmic flows and the promise of AI productivity gains a decade from now, while the actual U.S. economy is still 68% dependent on everyday people buying physical goods, what happens when these two realities finally collide?
Something has to give.
Right. Could we be staring down a bizarre, dystopian macroeconomic scenario where the S&P 500 continues to hit record highs month after month, entirely disconnected from a physical Main Street economy that is actively contracting in a localized recession?
It's a very real possibility.
Because if that divergence holds, the ultimate referee of the American economy won't be Jerome Powell or the Federal Reserve. The ultimate referee will be the American consumer staring at their receipt, completely unable to fund the illusion any longer. We will see how the retail lie detectors respond. Until next time.